This chapter will talk about current liabilities and payroll. So this is a list of your learning objectives for the chapter. Current liabilities are bills or liabilities that are owed to creditors or to banks or, again, companies, individuals. It's something that the debtor owes. And what makes them current is that they're going to be paid within 1 year. So 1 year or less is a current liability. We'll also talk next chapter about long-term, and those will go beyond a year. Accounts payable is the most common. So if you are just starting off in accounting, a lot of times you actually work in the accounts payable department. Those people receive invoices in from all of the vendors that the company has purchased from. They process those invoices and submit those for payment. So it's a very large part of the company in the accounting world, and then it's going to be the account that holds all of those kind of short-term bills as they come in, and then the company pays them out. If the company has long-term debt, there can be current portions of that. So say they have a mortgage or a car loan, whatever is due in the upcoming 12 months would be classified as a current portion of that long-term debt. Short-term notes payable. So notes payable are a way, like maybe you've requested a little bit longer terms on an invoice, or maybe you bought some sort of an asset that you need a little bit longer than, say, like the regular 30 days to pay. You can sign a notes payable, which is a contract or a promise to pay, and you'll also pay interest. So with this example, they're going to charge 12% interest on the $1,000. And again, though, if we look at where is it coming from, it's coming from an overdue account. So we had an accounts payable, we could not pay it. So we signed this 90-day note with them to give us a little longer terms. And then the reason the company would do it is because then they can charge us interest on that. So then our journal entry would be to take it out of the accounts payable. So we debit that, and then we credit the notes payable. Then as that notes payable, as time goes on, we're going to incur interest expense. So we use our interest formula, which is up here at the top. It's our principal times our rate times our time. And our time is always expressed in terms of a year. So in this case, it would be 90 over 360. And you think, okay, well, wait a minute, there's 365 days in a year. You are correct. What banks use what they call ordinary interest or banker's interest. So they just assume, let's just say all months have 30 days. So we put that over the 360, which is, again, ordinary interest or banker's interest. So then we'll calculate that interest expense, and then that's what we would owe it when the note comes due. We owe them the principal plus the interest. So the cash we pay is principal plus interest. The journal entry is going to take the notes payable off of the books by debiting it, and then charge interest expense for the $30 for those 90 days. And then here, again, shows us some different transactions. They purchase the material to put it into their accounts payable. Then they issue them extra terms, the 60 days, and they take it out of accounts payable, put it into notes payable, and then they incur the interest expense when they pay it. Then they're also showing you on the other side how would the other customer have done it if they were the ones receiving it. So they'd have a notes receivable, they would have interest revenue. The company may also borrow from the bank. And again, it's going to be basically the same way. We still calculate the interest. Now, in this case, it's obviously not on a past due accounts receivable. So if we borrow from the bank, the cash comes in, we set up that notes payable, but notice we still calculate interest the same way. So it's principal times rate times time, times in terms of days, and it's over 360, again, because it's ordinary or banker's interest. Now, sometimes notes can be discounted, and then really what that just means is we calculate the amount of interest, and instead of paying it back at the end, it is paid up front, or the lender keeps it. So let's see if we have an example here. So if we have a $20,000 90-day discounted note, Again, we calculate the interest the same way, so principal times rate times time. So we have a discount of $750, but instead of getting the whole $20,000, we get $20,000 less the $750 interest. So then the cash is $19,250. We have $750 interest expense, and then we owe $20,000 at the end of those 90 days. So it's not paying the principal and interest at the end, it's paying the interest up front and then paying the principal at the end. So then here you see the cash that goes out at the due date is the $20,000. All right, so I'm going to skip through those examples just to save time. Okay, then payroll and payroll taxes are another very, very common current liability for large businesses who have a large number of employees. And you're going to see there's going to be all different types of liabilities that go along with payroll. So we've got salaries and wages. So salaries refer to maybe like your managerial type staff, people who are on salary. Wages are for the people who clock in and are paid more on an hourly basis. And then we're gonna go through our regular payroll type process. So a standard work week is 40 hours a week. And then if we work over that, it's going to be paid at time and a half. So here we have an employee, John, who makes $34 an hour. He gets paid time and a half for anything over 40 hours, and he works 42 hours in this week. So we take 40 times the 34 hours, and that gives us his regular pay of $1,360. Then we take the 2 hours of overtime times his hourly rate times 1.5. So that 1.5 represents that he's going to get his regular $34, but then he's also going to get that overtime premium. So 1.5 is the time and a half. So then his total paycheck would be $1,462. Now that would be his gross pay. So hopefully all of us have had jobs. We realize that we don't really get paid our gross pay. We get paid the net pay. So what is in that net pay is all of these different taxes. So we're going to have to compute those and then subtract them from the gross pay. So here shows you a W-4. So you fill those out. They're a little more complex in today's current environment. This one's a little bit dated. But basically what you're doing is you're explaining how many exemptions you have and if you're married or single, so how you would like to have your taxes withheld. And again, the more exemptions that you have, the less they'll withhold. Some people choose to just go single and zero so that the most is withheld. It's really up to you how you want to set those W-4s up. And once you know their filing status, are they married, are they single, how many exemptions do they have, then we're going to go to the tax tables to figure out what the taxes are. So here shows you how we calculate it, if we're going to calculate it manually with the formula. And then again, like I said, though, there are detailed tax tables that you can, the wage bracket method, that you can go kind of line by line and figure that out. And again, I'm going to skip through the examples for time's sake, but feel free to look those over in the PowerPoint. FICA tax is basically Social Security tax and then Medicare tax. So we have two different components to it. Social Security tax is actually 6.2%. And then Medicare, all right, so I guess we'll just go along with the percents that they have here in this slide. Okay, but I feel like they're not 100% correct, but there's a set percentage for our Social Security tax, and then there's a set percentage for our Medicare tax. So if that we go back to John McGrath and he has those gross wages of $1,462, we'll multiply that by our Social Security rate to get our Social Security tax. And then we'll multiply that by our Medicare rate to get our Medicare tax. and then we'll add those two together, and then those would be withheld from his paycheck. There also can be additional amounts that are deducted from their gross pay if they have items that are going into their 401k, if they have charitable contributions like paying to the United Way, or maybe, at colleges, sometimes we can give to the Scholarship Foundation and things like that, or life insurance. So all those things could be deducted, health insurance. So our gross earnings, less all those deductions, gives us our net pay or our take-home pay. So here they show, again, same guy. Then we've deducted his federal income tax, his Social Security, Medicare, what goes into his retirement, and then what is going to the United Way. And that leaves us his net pay. And again, I'll skip the exercise. Then we go to, okay, that was the employee side. That's what came out of their paycheck. What about the employer? The employer has to match that Social Security and Medicare tax 100%. So whatever comes out of the employee's paycheck, the employer also has to pay that exact same amount on the employee's behalf. So the employee basically pays their half and the employer pays the other half. FUTA is normally not paid by the employee. It's only paid by the employer, and it too is going to be a set percentage, and it's only up to the first $7,000. State unemployment is normally also only paid by the employer, and every state and every employer has a different rate, so that's not a set one. You would have to know what the rate is for that company. So again, this shows you kind of graphically who's responsible for what, and it all ends up getting paid into the IRS. And most companies are going to use payroll systems, payroll software that files all the paychecks and keeps track of the payroll register. So what all did they pay that pay period? It then goes into the employee's earnings records so that the employee can look to see what is their year-to-date pay, what's all been withheld. And again, the paychecks are cut from that. So in that payroll register, again, it's going to have all of the details that are included in that pay check anywhere, and then for all of the paychecks for all the employees. So here gives you an example. So again, we've got these 6 employees, and then we go down and we can tie out the detail. How much Social Security tax, how much Medicare, how much federal income tax, retirements, miscellaneous deductions, what was their net pay, what was the check number, and then over here shows us what accounts are we going to debit and or credit. So again, you'll see we're going to have separate payables for all of those withholdings. So as we look at this journal entry, it shows us all of that. So we debit our sales salary expense, we debit office salaries expense. Then these are all of our payables. So notice we've got Social Security tax payable, Medicare payable, employees' federal income tax payable, retirement savings deductions payable, the United Fund deductions payable, and then our net pay goes into our salaries payable, and then we would pay it out of that as we paid the paychecks to the employees. So again, I'll skip over those examples. You can look through those on your own. So that was the paycheck side. Now we're going to pay those payroll taxes when they come due at the end of the quarter or the end of the month, or however often it's due for us. So we've got the following payroll data, and we have wages that are subject to Social Security tax, wages subject to Medicare tax, and then wages subject to our federal and state unemployment taxes, because there's a limit. So not all wages. Employees normally meet those limits, they're like $7,000, they're a smaller amount. They'll meet those early, and then any wages after that are no longer subject to state or federal unemployment tax withholding, or not withholdings, but payments. So here we'll do the computations. So again, we use the dollar amounts they give us, what wages are subject to what tax rates. So these were our wages subject to Social Security. These were the wages subject to Medicare. And then again, the lower wages are subject to SUTA and FUTA, or state and federal unemployment. and then our rates accordingly. So then we add those up, and those are our total payroll taxes that the employer is going to have. So then their entry is to debit payroll tax expense for the whole amount, and then to go into each separate payable. Because again, this chapter is dealing with those current liabilities. You can see that each one goes into a separate current liability depending on what type of tax it is. Now notice the Social Security and the Medicare also had the employees portion going in there. But then these two, the state unemployment and the federal unemployment, are only applicable to the employer. And then we got the employee's earnings record. So again, it just shows you kind of what that would look like. It's going to give the individual's name and then their year-to-date earnings. So then we would have, each paycheck, what did they make, what was withheld, what was the net amount. And it would go through the whole year-to-date and give us that detail. Then at the end of the year, the employer prepares a W-2 that shows a summary of those wages paid and then what taxes were withheld. So again, that would be prepared by the employer and then mailed to the employee. And then companies, most of the time in today's world, they're doing direct deposits. Most places I've worked at recently require you to have a direct deposit versus giving you an actual hard copy paycheck that you take to the bank. And then you would also get a statement. So for us, we actually have to log in to our account, look at what our statement was. It's not even emailed to us anymore, again, for security purposes. And then the amount is direct deposited into our accounts. And if they did, though, so back in the day when I worked at the oil and gas company and the manufacturing company, we did actually get paychecks back then, and we would have a separate account at the bank for our payroll accounts. So for at the oil and gas company, we had an accounts payable account, we had an operating account, and then we had a payroll account, and then actually a revenue because we had to pay out royalties to people. So we had 4 different bank accounts, again, kind of designated for what their purpose was. And everything is computerized. It has all of the data in there, a lot of personal data too. So we need to make sure that that is all safe. So then we get into our internal controls again, because this would be an area that would be prone to theft if people could do it. So we want to make sure that everything is properly controlled. So our checks are properly controlled, that if we hire new employees, they're properly authorized and approved according to our policies and our procedures. Any changes in pay are also properly approved, again, according to whatever our policies and procedures are. We want to verify that employees that are paid hourly, that get those wages, that they're clocking in and clocking out accurately, and that then they're being paid accordingly to those time sheets or what's going into the computer system. And then the payroll checks, from an internal control standpoint, it's good to have somebody else distribute them. If you're distributing them actually in person, again, like I said, nowadays everything's so electronic. So for us, it would go to an email. But then the thing is, the payroll person can't set up email addresses. So the IT people are setting up the email address. So in a sense, they are the double check. So if there's no, email address at the college, then and this person's getting a paycheck, that would raise a red flag. Then employees can also have fringe benefits, so they could get paid vacation pay, they could have medical insurance and retirement 401ks or pensions, and those are all also going to be liabilities to the employer, the company. They're going to want to set those up into separate payable accounts. So here we have vacation pay expense as it gets accrued. We're going to set it up into a vacation pay payable, and then we will pay it out of there as the employees take their vacation. And then normally in a lot of companies, they make their employees take that vacation within the current year, either you use it or you lose it. Sometimes they're allowed to accumulate it into the next year. But again, it becomes a little bit more of an accounting issue at that point. And then again, like I said, when they go to take it, when they take that vacation pay, we've already set it up as a liability. So when we pay them, we're going to debit vacation pay and then write a check or, pay them wages payable and then pay them out of there. Pensions, again, pensions are something that provides a retirement for employees. And there can be a defined contribution plan or a defined benefit plan. The defined contribution plan, the company is going to invest contributions on behalf of that employee during their working years. 401ks are very popular. Most companies are using those nowadays so that the employee is putting in a percent of their paycheck, and that comes out before you calculate federal income taxes. And then the employer normally matches it or matches a certain percentage of it. And then again, you would withdraw those at retirement, and they would be taxable to you at that point. So when the employer matches that, they're going to have an expense involved, and they're going to debit pension expense, and then pay that out to whoever is handling the normally it's an investment company that's handling that 401k. And then a defined benefit plan is more of like what public school systems have, maybe public police officers, people like that, government jobs will have a defined benefit plan that is based on how long you've worked there and your age, and then what your salary was during that time frame. And then that we're going to debit our pension expense and then credit cash to record the payment. And then any additional liability is going to go into an unfunded pension liability account. Now, the unfunded pension liability account would be a current liability if it's going to be paid within the current year. If it's going to go beyond that, it would be considered a long-term liability. And again, there's a whole list of other type of benefits. Depends on where you work, that you could have dental care, vision or eye care, definitely health insurance, life insurance. There could be tuition assistance. There can be tax services, legal services. So there's all types of benefits that employees can offer. And then even after retirement, again, some of those could be offered. So we just have to ensure that all of our liabilities that the business has are always documented and included in our balance sheet. And again, identifying if they're current or long-term. Then we get into contingent liabilities. So these are ones that could be potential obligations in the future. So like say there's a lawsuit that the company is involved in, will they end up paying or will they not? So what we look at is, what is the likelihood? Is there a strong likelihood, that we are going to end up paying on this lawsuit? Is it probable? If it's probable, then do we have a potential liability? Do we have the amount that we're going to owe? Because obviously you have to know what the amount is before you could book it. So it would have to be probable, and then the ability to be estimated. And then we would debit expense, and then we'd credit a payable. So here they're giving us an example of a warranty. So we sell a product, we offer a 36-month warranty. We estimate that a certain percentage is going to come back in repairs, and that we're going to owe it. So we take the 5% times the sales amount, and then we'll debit product warranty expense and set up a product warranty payable. Then as that product does come back to be repaired, we will take that out. That repair cost will come out of our product warranty payable. So then there we debit the product warranty payable, and then we credit supplies. If it's not probable and not able to be estimated, we don't record an entry, but we just disclose it in the notes to the financial statements. Again, same with the reasonably possible. The only time we don't make any disclosure is if the attorneys or whoever our experts are say we think that the chances of actually having this liability come are remote. So here they give you a nice little table that gives you the different levels, but So probable and estimatable is what we're going to record and disclose. The other ones, we just disclose them only. Only remote are the ones that we don't disclose at all. And as our chapters end, we normally have ratios that we compute based on those. So in this section, we have a working capital, which is the formula is current assets minus current liabilities. Very similar to that is our current ratio, current assets divided by current liabilities. So both of these are measuring the company's ability to pay their short-term debt as it comes due. Then the quick ratio gets it a little bit more precise. It's like instant. So it says your quick assets, which are cash and accounts receivable, and if you had very short-term investments, things that are going to convert to cash quickly. So the major item that is not included in there is inventory. Inventory is not going to be included in our quick assets because, again, we can't turn it into cash quickly. So here they're going to give you an example. We've got our balance sheet, or at least a portion of our balance sheet, and then they're going to solve those ratios for you. So again, if we look back though, the quick ratio, we've got cash, temporary investments, and accounts receivable. And those are the three items that are on the top. So cash, short-term or temporary investments, and then our accounts receivable divided by our current liabilities. Okay, so that is our current liability chapter. Thank you and good luck.